All right, let's do another video update. It's Thursday, October 10th, 9:15 p.m. Eastern Time. We had a CPI report today, and the core CPI and the headline CPI came in hotter than expected. But the market tended to shrug it off. Most markets ended up, not having huge moves on the day. If we look at the super core CPI, it came in at 0.4 month over month, and on a year over year basis, it's at 4.3. So 4.3% on super core, that's a long way from the Fed's target of 2%. So that calls into question just how quickly the Fed can cut rates. Now, scanning X today, we saw that most people tended to think that this wasn't a big deal in terms of what the CPI report had to say. They think that things are still moving progressively towards 2% for core inflation, and this wasn't much to worry about. But the person that I like to go to when it comes to inflation is Michael Ashton. He was one of the leading market makers in inflation derivatives and one of the first to help actually create those derivatives in the early 2000s. And according to him, this report was unpleasant because unlike the last report where it was hotter than expected, but because of one particular component, this was hotter than expected because of multiple components. And he said that balanced nature of the report that made this hotter than expected was, in his words, unpleasant. And he thinks that core inflation will settle in the high 3s or low 4s, and thinks that the Fed will not be able to get core inflation down to 2%, which, if you've watched any of these videos or read the weekly commentary, that is my contention that we're in a secular bear market driven by high inflation. Inflation may come down temporarily, but it's unlikely to stay low, and it's likely to reaccelerate. So Ashton makes the point. He plots the last 12 months of core CPI month over month, and we had nice reports in May, June, and July, but he said those are starting to look like the outliers as opposed to the rest of the month's results. And he says the same thing for for the median CPI, that May and June look like the outliers compared to the rest of the data points. And if you look at the Atlanta Fed Sticky Price Consumer Price Index, it's settling at, right now it's at 3.9% month over year over year. It was at 3.5% in August, so it rose 0.4% on an annualized basis, 0.4 percentage points on an annualized basis from August to September. And they're saying now it's at 4%. So that's not close to 2 either. So again, inflation is likely to be a long-term problem, at least until the end of the decade, if not into the middle of the next decade. Now, what effect has this had on the dollar? Well, the dollar has essentially put in a false breakdown after the Fed rate cut. It fell below this horizontal blue line. It didn't rally immediately the next week. It also kind of came back and tested that post-Fed low. Did it several times. It had this kind of fake out, this green candle here. It jumped, but then the next 2 days it gave it all back. But starting at the beginning of last week, it's just been taking off. It's up, I think, 8 out of 9 days, and it's up over 2%. And it looks like it might want to target this blue line here. Now that blue line is where the dollar broke down because of the early August jobs report, which is much weaker than expected. And at the same time, the yen carry trade was unwinding. And so the dollar really got hammered. But we've gotten a strong jobs report since then, and we've gotten a couple hot CPI reports since then on the core CPI. So given that, and given that the implied pricing for the Fed funds futures for November is suggesting that the Fed is only going to cut 25 basis points as opposed to 50, whereas there was some thought that they might cut 50 again. And now there's actually some question as whether they will actually cut. There's some probability that they don't cut. So given that things have shifted in a more hawkish direction with interest rate pricing and with interest rates, as we'll see in a few minutes, it would totally make sense for the dollar to unwind back to the level where it started to fall because people were scared of a weakening labor market, which they don't seem to be so scared about anymore. So this line here, this blue line at roughly 104, is where I think the dollar would at least get to over the next several weeks. And dollar relative sentiment is still bullish. The spot positioning, how things are moving on a unsmooth basis, is moving towards the neutral level and potentially becoming bearish as the smart money has been selling the last few weeks. But the dollar relative sentiment is a smooth version of that green line, and it won't turn bearish until at least late November and potentially even early December. So the dollar will have ample time to continue to rise, given that dollar relative sentiment will still remain bullish for several more weeks. Now, it didn't rise when dollar relative sentiment turned bullish, so there's no guarantee that it will continue to rise, but historically speaking, the tendency is when dollar relative sentiment is bullish, the dollar tends to rise, and it's starting to do that, and it has a lot more time left with dollar relative sentiment remaining bullish. So we'll see if it can rise from here. If we look at interest rates, so this is TLT, it's made a huge move in the last several weeks as the dollar has bounced, as the economic data has come in stronger than expected or hotter than expected. It went from a 3.9% yield on the 30-year. Now today it crossed 4.4%. This red line roughly corresponds to 4.4, 4.5% on the 30-year yield, and that was a big level for several months. So we're right back at that level. And a few weeks ago when TLT was up here, my thought process was, okay, if we get a recession, well, equities are going to fall, unemployment's going to go up, income taxes will fall, capital gains taxes will fall, tax receipts as a whole will fall, spending won't fall, so the deficits will get higher. They can't keep issuing treasury debt at the short end because eventually you'll have too much that you have to continually roll over, so they have to start parsing that out to the longer end, and that supply at the longer end would drive rates higher, and it might actually cause the Fed to have to cap rates at the long end so it doesn't blow up the U.S. fiscal situation. But then inflation would skyrocket. On the other hand, if we have inflation, then rates should move higher as well, because a sub 4% yield on the 30-year isn't really going to compensate you for the likely inflation if inflation were to reemerge. And inflation looks like it might slowly be reemerging. So it didn't seem to make sense to have rates, at least the 30-year yield, below 4%. And now it's back to the mid fours. And if you look at 30-year yield chart itself, we see that it's in this falling, broadening wedge pattern. And if you say to AI, hey, what type of resolution do falling, broadening wedge patterns tend to have? They say it's a bullish breakout. And recently, in July, I think, before the Russell 2000 really went crazy to the upside, where it gained like 12% in 12 days or something like that, it was in a falling, broadening wedge pattern before it broke out. So we might see this 30-year yield continue higher and potentially, above 4.5%. So we'll have to keep an eye on that, because that will likely have an impact on most other markets. So long bond relative sentiment, composite relative sentiment is bearish. It's been bearish for the duration of this red segment here, and you can see that the red segment is starting to move towards the level where it turned bearish. So it's starting to move where you would expect it to, given the bearish positioning in long duration bonds. If we look at gold, so gold, it has obviously positive momentum and the price has been rising, but if you look at its relative strength index, it's actually showing a negative divergence. Now, positioning has been historically unfavorable for gold the last several months, but gold has shrugged that off. I think part of that is because of central bank buying. Central banks would rather own gold than long duration bonds, because long duration bonds in an inflationary environment will give you negative real returns. Gold will adjust its price to give you positive real returns, and it's showing that it's really up for the secular environment that we're in. However, we do have this negative divergence in terms of price and momentum. And well, this is silver. Silver's pulled back a little bit more recently, almost a 10% pullback from 33 to almost 30. But here's China's gold buying, and this is the reason why we should possibly be cautious on precious metals, given the negative divergence with price and momentum. But China's buying has been waning, so China's smart. They know that a lot of the rise in gold recently has been because of their buying and central bank buying. So it would make sense for them to kind of take their foot off the gas, especially because if you look at managed money portfolio managers, they have the highest net long position in gold that they've had over the last 10 years. So if China stops buying and there's no one left to buy and gold starts to fall, these portfolio managers are going to have to sell their gold. It'll drive the price lower. China will step in to buy at a lower level, most likely. So that's why I think that we might finally see some type of material pullback in gold and silver. Also, this is a chart of, this chart was from the market year. This chart was also from the market year, as is this chart. It's an overlay of gold versus the dollar, and you can see that as the dollar was falling, it's the inverse of the dollar. So as this purple line is rising, that's the dollar falling. Gold was rising as the dollar was falling. Now the dollar's rising, and gold really hasn't given much back of its rise. But if the dollar continues to rise, and I think it has that potential, given the economic data, given the perceptions have changed, given that it tends to retrace vertical declines or vertical increases, it tends to retrace to where those increases or declines began, which would be 104 on the dollar, which is another 1.5–2%. And so it's not implausible that gold would actually follow the dollar. So dollar higher, gold lower. We might actually get a meaningful pullback in gold this time. Same thing with gold and interest rates. So as interest rates were falling, gold was rising. Now interest rates are rising. Gold really hasn't given back much, but it might catch down to where rates are with respect to this relationship. Now, before we get to equities, let's look at commodities, because commodities are in a zone in terms of their sentiment that tends to be a headwind for equities. So here is a chart of retail macro sentiment and crude oil, the commodities index at large, and lumber. And when the sentiment tends to be, this is a sort of a generalization here, because each of these sentiment indices has its own Goldilocks zone. But I just plotted one generic one in this plot. But the idea is that when the sentiment is inside the Goldilocks zone, that's favorable for equities. That's a tailwind for equities. So you don't have inflationary pressures, you don't have deflationary pressures. The coast is clear, equities can do their thing. But whenever these sentiment indices rise above the Goldilocks zone, that tends to suggest that. So why would it rise above the Goldilocks zone? That means that retail traders are really excited about this asset. Well, why would they be really excited about the asset? They'd be excited about it if it's rising. And if it's rising to the degree that they'd be that excited about it, that could lead to inflationary pressures. On the flip side, if it falls below this zone, then retail is really bearish on the asset, and retail, they're price followers, so they're only bearish whenever the price falls. And if the price is falling such that they're that bearish on it, it could lead to deflationary pressure. So deflationary or inflationary headwinds tend not to be good for equities. When it's in the Goldilocks zone, that's good for equities. Well, right now, two of those three indices are outside the Goldilocks zone. And when that happens, equities tend not to do well. So this is a chart. The red and orange lines, the red line is when crude oil is outside the Goldilocks zone. That's how equities do, how the S&P 500 does, or the U.S. total equity market does whenever crude oil is outside the Goldilocks zone. And the orange line is when the commodities index, the CRB index, is outside the Goldilocks zone. So the red and the orange is the total U.S. equity market when either the crude oil or the commodities index are outside the Goldilocks zone of retail sentiment. And you can see equity market doesn't do very well when either or of those is outside the Goldilocks zone, and right now both of them are outside the Goldilocks zone. So the last time this happened, when I actually made this chart and put a tweet on X, equities, did face some headwinds. They didn't really go anywhere. They might have fallen a couple percent while it's happening again. And you can see that commodities have risen recently. This is GSG, the Goldman Sachs Commodities Index. It's gone up 10% from 20 to 22 in, this is a weekly chart, so in 5 weeks it's risen 10%. That's pretty strong. And a lot of that rise came in the last 2 weeks. Now you can see it's at the top of this trend line, which kind of looks like a descending triangle pattern, which would tend to suggest that this would move lower and below that blue line, this 19 level. But commodities are in a secular bull market that began after oil went negative in April of 2020. And so we would expect this to, after consolidating, after this big rise and consolidated, we would expect that to eventually resume its upward trend, and that might be on the precipice of happening. We'll have to see how it responds here. If it breaks higher out of this triangle, then I would expect equities to kind of struggle a little bit. I do think that equities would tend to do more of what they've been doing, which is kind of going sideways. They've been sideways drifting higher, but I think they would probably be sideways drifting lower if commodities rallied outside of this triangle. Now, if commodities pull back, then I think equities can potentially continue to rally. So let's look at equities. So equities kind of feel tired. They've been struggling, the last few weeks, not going much of anywhere. They're up slightly, but it's been very choppy. You can see that this is the S&P 500. It's in this rising wedge pattern that tends to be bearish. The price has been rising, but the momentum, the RSI index, has been decreasing. So that's something to keep an eye on. And composite equity relative sentiment will be, currently it's in this neutral zone here between 40 and 60%, but as of tomorrow it's going to fall to 35% or 38%. Yeah, 38%, which is in this 20 to 40 bucket. Equities tend not to do well in that bucket. That's corresponds to this brighter red line here, the 20 to 40 bucket. That's how equities tend to do. Now, I don't think it's going to stay and the reason it's falling into that bucket is precisely because of the commodities retail sentiment that we just talked about. That indicator went from 100 to 33% in the course of a week, and so that drove the composite down from 52% to 38, 39%. I don't think it's going to stay below 40% though, because I don't think, well, we'll see how commodities play out. If commodities keep going higher, then yes, it will stay in below 40%. But if commodities pull back, then the commodities retail sentiment indicator will probably rise again, and that would probably take the composite equity relative sentiment back to the 40 to 60 zone, which is this middle gold line, which again, outside of 1995 to 2000, it's essentially gone sideways. So, we might not see the equity market melt up just yet. It might have a few more weeks of sideways turn. It might have to pull back a little bit. I still think that there's a reasonable chance that the S&P could come back and back test this line here, the 1.618 Fibonacci extension. That would make sense for it to kind of hit there before maybe making a run higher after the election when uncertainty has been eliminated. But in the process, so we have an equity market that was pricing in a lot of Fed cuts, but economic data is coming stronger. The jobs market is picked up a bit. Implied pricing of Fed cuts has gone lower, so fewer cuts. Yet valuations are almost the second worst ever. They're still the third worst ever, but if we have a rally tomorrow, it's plausible that this latest data point could surpass the everything bubble data point if we have a decent rally tomorrow on Friday. And long-term returns are expected to be 0.2%, and the equity market's been rising as interest rates have been rising dramatically. So you're getting more yield out of bonds and less yield out of equities, and consequently, the expected risk premium for equities is now at the worst level of this cycle, of this secular, bear market, at minus 3.9%. If we get another day tomorrow with rates rising and equities rising, this could go below minus 4%, meaning that on an annualized basis, bonds would likely yield, the 10-year bond would likely yield 4 percentage points more than equities on an annualized basis over 10 years. So equities from a long-term strategic perspective, extremely unattractive. The future doesn't look super bright for U.S. equities. It looks better for global equities. They have better valuations. They should probably outperform on a relative basis if the U.S. equity market falls substantially. But again, with the inflation report today, it's a reminder that we are in a secular bear market driven by high inflation. Inflation is likely not going to go away. And we're only likely to tread water with respect to inflation over the duration of this cycle. But the chance that we just move, with inflation, as opposed to having sort of a roller coaster up and down like we've had in every other secular bear market, these red or orange segments, I think that's too much to ask for the market just to kind of gradually increase at the rate of inflation, as opposed to being choppy as markets always are. So on equities, might be a week or two here to be cautious. Could be some headwinds, some churning. I don't think that we're ready to melt up just yet. We'll see how it plays out. But again, the big news today was CPI. A lot of people didn't think it was a big deal, but the person who really understands CPI thinks it was a big deal. Doesn't think the Fed will stop cutting rates, but doesn't think the Fed will be successful in getting inflation down. So that's all for today. If you have any questions, feel free to reach out, and thanks for watching.